What's going on, guys? This is Baro, aka Invest Mentor. Thanks for your time and watching. Today is September 3rd, the last month of the third quarter. And it's September 3rd, Friday, and thanks guys, Friday again. And I hope all of you have been enjoying a great week. You know, especially with all the lucks in your trading and investment. And as usual, I have to say, like this channel and this live stream and all the stuff produced on the channel, Baro Invest Mentor, is purely only for entertaining, informational, and educational purpose, without any financial advice. So please always do your investment research and due diligence for all of your trading and investment, and be responsible for your own P&L, please. Okay, so it's about 12 minutes before market open, and what's been going on recently? We have been seeing the U.S. stock market. U.S. stock market just getting higher and higher and higher and higher. It's non-stop. So we have another. We had another breakout in S&P 500 and Nasdaq index this week, and we have a lot of record highs in all the blue chips, the big stocks, the bigger corporation, after all the good earnings in second quarter, in the third quarter. And then after last Friday, this week, we also have good news from the Davos speech of the Fed Chairman Jerome Powell. Last Friday, he was saying, we don't need to be panicked. We don't need to be too sensitive to the, the environment. So, implying, the Fed may do the paper more relatively in a mild way. In the, we're not sure if it's gonna happen in this month or in next quarter. Okay, and this week we also have some economic data from the job market. On Wednesday we have the non-farm payroll, which is just up below, which is under expected. Just we have about 350,000 new job roles, and today we have the this weekly weekly jobless claim, and but all the the labor market, the job data just imply that the labor market is still recovering in a good pace. It's not too bad. And so next Monday is September 6th. It's going to be a Labor Day. It's going to be Labor Day, U.S. Labor Day. And in recent years, we have been seeing a lot of the national holiday stock market rally, and also I think especially every just a trader and the investors for U.S. stock market is expecting the Labor Day rally again next Monday, right? So that's about some of the events going on this week, last Friday, and until next week. And besides all that, today we're gonna of course we're gonna spend some time to check into some of the stocks, the tickers we have been following in the watch list. And besides that, I also wanna discuss the things which has been thought and considered by a lot of traders and investors in recently, about US dollar collapse or US dollar falling. Okay, so because why we need to why we have been thinking about this more? Because of the money printing cycle, right? The government, the Fed has been printing money like, you know, over and over. So there will be, so in today's live stream, it's gonna be more discussion on the you know, the economy, like instead of like single stocks, right? Because I mean, I mean, like Warren Buffett always say that when the market is really hyper, when the market is getting greedy, we have to be, you know, extra like alert or cautious, right? So that's what's been going on right now. And the, you know, the market rally, the stock market rally, and soaring and surge and like, you know, frenzy, just like what we had in 1999, right, before the 2000 .com crash, right? Later on, if you have time, you can check into the, you know, historical chart of all the like stock indices. We look pretty much the same. You know, we look pretty much the same as you know, what was happening in 1999 before the 2000 .com crash. And so I'm just trying to figure out, is it the case? Is it really a warning signs for us to be cautious or alert? And if it is, like, how we can react, right? So like, you know, instead of like talking to like, you know, drilling into like single stocks, like, you know, that's gonna be like too much details. So like sometimes we also, I mean, for the you know, the stocks trading investment, we also need to step back a little bit into you know, observe the bigger picture to see how the entire economy, the global economy, is going, and then you know, make a you know just you know, proper move of our asset allocation, portfolio management, and risk management, instead of like chasing the greed, chasing the profit behind all those like ticker single stocks. Okay, so let's see. Like, thanks for some of the chat here. Thanks for Snowy Sophia. Thanks for Soda Cookie and Snowy Sophia. So hi, yeah, good morning. Any good stocks to buy during Labor Day holidays? Yeah, we will see. You know, it's been a lot of like good stocks to buy. You know, in the past like half a year to 1 year, right? Like almost like, you know, like over like 70% of the single stock in the market have been good to buy, right? But like today, as mentioned, we have to spend a little bit of time to look at the bigger picture. Okay, so excited! Labor Day weekend is coming. Yeah. So Soda Cookie, like, you got any plan for the Labor Day weekend? Seems that you are going to have a great time with your family and friends. And Snowy Sylvia, money market off. Monday market off. Yeah. So yeah, what stock am I buying? Yeah, I will also gonna like, you know, talk about that. This it's not actually Snowy Sophia, thanks for your question. What stocks, what I'm buying? So because I'm still new, I'm still like young compared to those like you know, guru and, you know, senior experts in, you know, in the trading investment world. So like most of the time, what I've been doing is just like reading a lot of information and article, trying to do the like investment research to make you know, just to process those information to make my own conclusion decision. And recently we know like somehow the US stock market, it's kind of oh sorry, I kept my music too loud. I'm not sure if he has been too loud, but I'm let me just down a little bit. So I'm not sure if the music is too loud or it is okay. So please let me know if it's okay. Yeah, it should be okay right now. Please let me know. And then please. Okay. So that cookie. Thanks for your reminder. The music, you say the music was too loud. And I'm not sure if the music is okay right now. Please let me know. Please let me know. And so just like few minutes before the market open, I'm gonna share some like just before we draw into like, okay, sorry, we were talking about, I have seen some like just asset manager for those like Wall Street asset, like super guru, like the Bond King Jeffrey Gundlach. He just like in recent weeks, like in recent days, he's been saying he's like moving some of his allocation into the European market and emerging market, because the US market is getting a little bit too hot or a little bit dangerous, right? So and also that's also mentioned by some of the just asset manager for stocks and bonds, in those investment banks and hedge fund. And after I read all those information, I also did some of the investment research a little bit. That's so I have some information to share today. Okay, but before like sharing some of the information, let's see what will be some of the the major news we got today. This we got like jobless claim. We just saw another 340,000 individual file new claim, but that's the lowest since March 2020. So this is saying the job market, the US job market is still going really well, even during the COVID-19 variant, Delta variant outbreak. So that's good. That's good. Good and bad. Good and bad. We also need to think from different aspects, and we can also see the title of this article, like Robinhood investors are propping up the stock market. That's JPMorgan. So later on, if you have time, I copy and paste like the information, this article links in the description box. Please check into that, and please always never forget to click the like and subscribe button, and leave some of your thoughts and comments when you for further discussion. Okay, so this article is mainly saying that like Robinhood investors stands for retail investors, right? Because I think like almost like all the like this American trader investor know that like Robinhood has been a platform for all the like young investors to get on that to trade meme stock, and just pouring money with their like stimulus check, I guess. And so that's the thing. This is just saying like the US stock market. Let's see. Then please. So they're saying like, I mean, in this article we can see that JPMorgan said a certain retail investor, most likely the younger cohort, buy stocks and equity funds aggressively. They push the equity market up strongly, making other retail investors, i.e. the older cohort, inadvertently more outweight equity, he said. And the later group has been buying bond funds to try to rebalance, which has brought those flows near to a previous record high seen in 2019. So in this article, it's been saying like, so this year, all the retail investors has been like, pouring their assets into the US stock market. And some of the older, like previous retail investors just like move some of their cash from the stock market into bond market. And so I mean, so what's the ripple effects? Like, actually, some of the, as mentioned in last quarter, in probably in May, we have seen, like, some of the corporate insiders from Nasdaq have, had actually, just selling stocks on the market. And some of the we can see, like, some of the institutional investors, like what I just mentioned, the Bond King, Jeffrey Gundlach, is even like moving the focus into European and emerging market right now. So so I'm not sure if you can like feel me, like when institutional investors and corporate insiders have been actually retreating from the U.S. stock market somehow, like retail investors have been pouring money to push the U.S. stock market like higher and higher. And so what will happen? So we're gonna like see some of the chart. We're gonna see some of the chart. Just a second, please. So the U.S. stock market start. The stock market just opened. Let's see like what will be some of the tickers moving. And please give me a second. I'll be right back. Hey, so sorry for the pause. So we're not seeing like some like like big move of any single stock. Like the top performer in my watch list today is DD. It's up for about like a 6% right now. It's having like a rebound so far. And the second one is RLXP, the Chinese stock. Some of the meme stock, Clover Health, and MicroStrategy and SOS, because we can see that Bitcoin is just like keep like picking up. It's breaking up over like 50,000. It's about like 50,700 right now. Okay, so besides all that, like let's come back to see the point I was going to cover today. Let's see if we have some more chat. So yes, no, Sophia. So what I'm buying. So back to the point, like I have been like in the past like couple of weeks, as mentioned in my previous live stream, I have like transfer like almost like 50% of the of the position I originally allocated to US stock market. US stock into Chinese stock, but for a big part of them, I still buy them through the US stock market. But I bought in those Chinese stock, like, you know, listed in US market or in Hong Kong market instead of A share. Okay. And why is that? Because I'm not just a retail investor. So I'm an amateur trader. So it's easier for me to trade and invest in the US stock market and Hong Kong market instead of the, you know, directly into the A share in China market. And what's the reason, you know, I made this move? Like, you know, if you have time, please check into some of my live stream and short video in the past couple of weeks, in the past few weeks, and I've been like mentioning, because I thought like Chinese stock are, but not all of them, but some of them have been relatively, you know, more like price worthy and cheaper for us to buy the dip with great discount. And a lot of the US stocks have been relatively too expensive somehow. Okay, that's the point. And okay. Yeah, you say like I'm not sure the music. Okay, so Michael Burry, yeah, thanks for your how's your day? My day is great. It's Friday, and it's been another, you know, just exhausting week, and you know, it's a Friday again. So hope you guys all enjoy this week, and you know, we're gonna have a Labor Day. We're gonna have a long holiday, Labor Day holiday next Monday. And so Soda Cookie, I think airline company or leisure related industry would be good to buy for the Labor Day weekend. Airline company, leisure related industry. A Soda Cookie, like you know, why I mean, like Soda Cookie, you just mentioned about airline company. So I mean, US airline and, you know, Delta and leisure related industry, like some like cruise or, you know, Disney, or, you know, what's your thoughts? I mean, why I mean, why I mean, do you think that would be a, you know, stock rally for airline company and leisure related industry over the Labor Day? So I mean, how much will be the rally over those company, from those company? And would you like, I mean, what would be your strategy? Are you going to, like, you know, do more relatively long-term investment from that point, or you simply want to do some like short-term trading, like day trading into those stocks? Like, please let me know more. Please elaborate more on your strategy for those stocks, so we can discuss further. So, but thanks for your question. You know, I'm hoping to have more discussion here. And Gemma, thanks for coming. So you say it's hard to say Soda Cookie. It's hard to say. Okay, so Gemma is also like having some thoughts on those like airline company and leisure related. So COVID is still an issue. Yeah, COVID, the Delta, as we just mentioned, like the third wave of the COVID-19 outbreak, it just came up, like, you know, in August, and it's still going, like, you know, it's still getting worse right now in the US market. And you know, just we saw the news, like the European Union just, like, you know, blocked the traveler from the US. Okay, so I'm not sure the Labor Day rally will be specifically on any specific industry, but I think that would be good. I think that would be good, like, you know, if for some like short-term trading, that would be good to take some action in those like US stock index, you know, for intraday trading. But for like, you know, mid to long-term investment, I don't see, like, I don't, because like usually for mid to long-term investment, usually like 3 or 5% of 3 to 5% growth in single stock doesn't mean too much, right? We have been seeing a lot of the stocks just like soaring or surging, like just like over like a couple 100% in just half a year or 1 year. So 3, 4, 3, 5 or 10% like daily moving is not actually something for if you are like doing if your strategy is more like just a mid to long term investment. But that's a totally different thing for short-term trading, for intraday, for day trading. So it really depends on your strategy and the, if you are a trader or investor. Okay, so yeah, so thanks for the chat. Let's I was going to organize some information, like please just give me a second so that I can get information for you here. So today's, I would say like today's like live stream would be relatively in a easy, chilling, and like just a lower pace. But my point this day, I mean, as I mentioned last time, I'm not trying to make you hyper, and I'm not trying to bring you some like a party like sentiments. Instead, I'm hoping to organize some like truly, I mean, really helpful information from my true heart. And of course, I'm not sure if those information will be really helpful or not, but at least I'm trying my best to organize some information that I thought is helpful and to just share with you sincerely. I'm not trying to just talk shit and swear and become a rapper to just pump your I don't know. No, I'm not like okay. Okay, so we have some information here. The first one I want to show you is like as you can see in the topic today, like labor market, and I also mentioned about the potential US dollar collapse, US dollar fall, and right, and the US stock market higher and higher, and how high it can go. So in this you can see the billionaire bond investor Jeffrey Gundlach, the new Bond King, just say what running our economy like we're not interested in maintaining global reserve currency status. So in this entire article, Jeffrey Gundlach, he just mentioned because of the money printing cycle, he thinks that like nowadays like this American, we just we have been like taking a lot of things as granted, compared to what we thought like decades ago, right? And so the government, the Fed, just like printing money like harder and harder to pump, to support, maybe from the political reason, maybe from the economic standpoint. And then it says I mean, Gundlach also pointed out that estimates for when China all right, sorry, I should like okay. He says that the US has enjoyed the status of sole reserve currency globally for decades, and it's an incredible benefit. He also pointed out that in the aftermath, the of the global coronavirus pandemic and lockdown, China economy has been the strongest economy in the world by far. While the US GDP has bounced back with a lot of consumption, a lot of that consumption is actually going to China. That's one of the reasons why China has such a strong economy right now. So, what we're seeing in the United States is starting to fall behind in economic growth. But that's not new thing. That's been going on for generation. The US falling behind. The investor also pointed out that estimate for when China's economy will be the largest keep getting pulled forward, noting some economists' projections show China's economy will surpass the US by 2028. And then right now, we have debt to GDP ratio that is fueling the majority of our so-called economic growth. So, think about that. Think about that, guys. Is it really economic growth when you borrow money or print money and then send checks to people who turn around and buy goods on Amazon? In addition to maybe paying down some debts and speculating in stock market. And all these productions and goods actually come in from China. Okay? So what's wrong with that? So we're running our economy in a way that is almost like we're not interested in maintaining global reserve currency status or the largest military power or so-called, superiority or dominance. So according to Gundlach, again, with the current economic policy in place, it's almost certain the US dollar should be going down, and we have been taking it for granted. We seem to take a lot of things for granted these days in the United States relative to how we thought about things in prior decades and generation. It's Gundlach's view that the US dollar has already peaked when the US dollar index hit 103. He believes that the dollar will take out the lows of the past down cycle in coming years. He thinks when we get to the next break of the lower level, the dollar will go past the most recent low of around 80 and even take out the record low of 70. Okay? So he thinks there is easily 25% downsides in US dollar in coming years. It's not gonna happen in just like few months, but it's happening. It will be happening in the next couple of years, okay? And it's like mentioned by a lot of investment banks like Citibank, JPMorgan, Bank of America as well. The downside of like US dollar will be like 20 to 30% in coming years. And so this may not cause a correction or market crash for US stock market right away, but we're not sure. But we are not sure. Maybe that it's also possible to happen right away in the in this month or in next quarter. Who knows, right? This stock market always react like faster than the others, right? So think about that. When the US dollar index like keep going down, like what will happen to the US stock market? Okay, so that's why like this Jeffrey Gundlach is also mentioning he's like moving some of his allocation into European market and the emerging market. Okay, but no worry. I mean, it's fine. I mean, as a retail investor, as a American, Taiwanese, or Chinese, or like European, whatever. I mean, the most important thing is for us to live our life in a good way, right? So to make some good amount of money. So, I mean, what what can we do? We can do nothing. We can do nothing to change the thought, to change the mind of the U.S. government or Chinese government or all the government. We can only do do the best for our own, right? And then let's see. Okay, that would be a huge problem. Thanks, Soda Cookie. So and new move variant could be more vaccine resistant. Yeah, right. I think some of the schools have already started maybe, but it's final summer. Okay, so yeah, thanks for the chat, thanks for the comments. So I'm not sure if all of you have already got like vaccinated, but please go get the vaccine. Go get vaccinated, as soon as you can. And we're seeing like people are getting the second dose, the second booster, and the third booster to be more, the virus resistant. But I think this situation will be released. Will be released like sooner or later, right? And like to be honest, from my 2 cents, I want to say for the coronavirus, for the variants, for all that, I think that's a tragedy. That's a disaster for all of the human beings around the globe. Recently in the since like 2020, but we can see that's one of the thing I have to respect, like American, right? The American has been American, and the American government have been trying to survive, have been trying to beat the pandemic, the virus, very bravely, right? They just that's also because of the democracy, the human right, a lot of things, culture and all that. So right now we can see American people, the U.S. government actually see economy is actually take the first priority on economy and the job market instead of the coronavirus. And somehow, although I think that's more like a scientific thinking, right? We count on the figures and numbers. When we have like thousands or tens of thousands of cases, like the coronavirus cases, or tens of thousands of deaths. Compared to the wartime, it's really nothing, right? So in comparison, as American, we still wanna the economy to be stronger. We still like pay more attention to the individualism, right? We still need to take care of our own investment and trading and our own like asset, like this capital growth and all that. We cannot. We just don't have that much time and sympathy to do kind of like the philanthropy, that kind of things, like to every single individual in the country. So that's how American has been doing, right? So but it's another topic actually. So okay, so Soda Cookie just say like, when will the disaster end? I don't know. I think like there has been a lot of like disaster, like financial disaster, or this kind of like pandemic disaster. So what would be really like a disaster is sometimes it really depends, right? Sometimes like when we are really poor, we would rather to be dead, right? So I mean, what kind of disaster is really, what kind of issue is really a disaster? It really depends on sometimes. Okay, I think that's I'm like a little bit like going too far on here, but let's come back. Okay. So I was going to say, let's see. Okay, that's one of the data I want to show. I want to show you. I want to share with you guys. You can see that this is according to Trading Economics website, and this is like United States money supply M2. What is M2? So we know like money supply 1, money supply 2, right? Money supply 1 is basically those like cash, right? You cash, and there's in your like a saving account, and money supply 2 is including more like a banknotes or like a you know, it's your deposit in the bank, you know. That's the liquidity, that's the US dollar, the money, you know, we have in the United States in the market. So it's very interesting to look at this. In the past, like since the pandemic, in the past like 1.5 years, we have the M2 from 15,000 surge all the way over 20,000 in just 1.5 years. Okay, so that's the increase. That's the increase we had from about like 1960 to 2000. I mean, from 1960, from the 60s to 2000, to the dot-com bubble. We spent like 40 years to have the increase in money, to have the same increase in money supply as what we had just in the past 1.5 years. So, I mean, you can see how steep the slope is. So, isn't it just crazy? And what just happened? So this is basically saying, like, you know, after since the like, you know, dot-com bubble, the government, the US government, that's also like mentioned in the article, like, you know, the Bond King like Jeffrey, the Jeffrey like Gundlach is mentioned. Please check into the link later on when you have time. It's like he mentioned, like, you know, this like American has been like, you know, it's like losing the I mean, has been like just like messing up with like whatever in the financial system, in the economic policy, and financial policy since 1980s. That's just so simple like this. Okay, so since like 1980s, because like Japanese economy was like you know, like catching up. So, you know, we have like, you know, this American, I mean, the government just like did something with Japanese, and then after 80s, like in, you know, we had like dot-com bubble in 2000, and then since then we just like keep like printing money, have all the like financial and physical policy to kind of like boost the economy. And like last year, like thanks to Trump government, especially since like 2016, like thanks to Trump government, and right now Biden government just had to extend that things, you know, the money, the US dollar is just flooding. But thanks to American ancestor, I mean, like we have this kind of like privilege or advantage to manipulate US dollar in this way to make all the American people living in a good life, good standard of life, at least so far. But is it gonna be you know, long lasting benefit, or will it be a nightmare coming up in the future? We have to think about that. You know, that's so through this chart, I mean, we just want to know. So the amount of money, the amount of US dollar in the market has been increasing much faster than the US economy is actually growing. So those like financial experts are saying since last year 2020, what's the economic growth, right? The individual, institution, corporate, and the government, like the entire US, the entire America, just like borrow money, just issue debts to support the economy, right? So we can see very interesting. Yeah, I thought this website's pretty interesting. USDebtClock.org. Okay. This is the figures here, so like counting updated to the so it's like a lively updated, and we can see like the US national debt amount is here, but later on you can check into some of the detailed like figures like when you have time. But I just want to mention like here, at the cursor I have here. So in 1960, US federal debt to GDP ratio was about like 52%, and in 80s, the debt to GDP ratio was about like 35%. That's about the time like US was, like beating Japan, beating like the American were like beating like Japanese, In 2000, the bubble.com, even in bubble.com crisis, the US federal debt to GDP ratio was about like 56%. But what's going on right now? Right now, the US federal debt to GDP ratio is 125%. Can you imagine? You borrow more money. The money you borrow is more than the production you can create in 1 year. That's going to be a really bad problem, right? Check into that. I'll be right back. All right, sorry for the pause again. So let's come back. So after that, let's see. So right now, like, the point I want to mention is like, why? I mean, in the past, like, since the 2020, the COVID-19 outbreak, like, why? Like, there's a lot of Americans don't even have to work, just like stay home for social distance, have the lockdown, but we still can have we still can, make our ends meet, and just survive without like work, and we can even just getting more money, because the U.S. government, has been helping American people, has been like issuing debt, and the corporate has been issuing debt. So like we see the corporate earnings has been like has been really good in the past 1.5 years, despite the pandemic, despite the coronavirus pandemic. We can still have all the growing corporate earnings, the growing economy, because U.S. government and the U.S. corporates have been issuing debts, have been borrowing money, have been raising more and more debts, and somehow it's the same. It's kind of like it's going to be a triple effect, like to the American people. But is it really going to be an issue? Like, I'm not sure, because if you can imagine, if you can recall, like what's happening in 2008 and 2000, actually the similar situation, the markets, like the stock market just like went crazy, and just but when there's a bubble got burst, like the biggest loser from the bigger picture, it's not like American people, right? It's the biggest loser are actually those like just global investors from other countries. They were like loaning US dollar to the US market, and later on the bubble bursts, and then they probably can get like maybe 80%, 70%, or even less less of their the previous investment, right? Like, it's a lot of the global investor, they just lend their US dollar to the US for like maybe 5 to 10% interest. Just yields, yearly yields. But in the end, they couldn't. They was not able to get those yield, and instead they even they even have a loss for another like 10, 20, or even 30%. That's what's happened in 2008, in what happened in the subprime mortgage crisis, and it seems to be like just like similar situation like happening again. So if you like later on, if you have time, you can spend some time to check into some of the because in the past, in the live stream short video, we didn't really check into some of the financial for those single stocks. But later on, if you have time, like for example, let's see, you can see for some of the fan stock, like for example, like Google, right? We just had an example, okay? Google stock has been like growing so beautiful, see the chart of like Google, since oh my god, this is like super, what a beauty, right? Like since the IPO in 2007, it's been like going up and up and up and up. We can't even see some of the like the choppy consolidation in between, right? And it's just like, what a curve is this, right? What a curve, right? And it's just like surge again. The stock price of Google just like surge almost like 3 times from the pandemic low in March 2020, from about like 1,000 all the way to almost like 3,000 recently. But that's the stock price chart of Google, right? So we have been talking about the fundamental analysis. We have been talking about fundamental analysis, technical analysis, but event analysis and macro analysis. But we never really spend some time to look into some of the details of the financial report of this stuff. So let's just take a Google for example. Okay, you can see. Let's see. Annually figure. So what's going on for what's the total equity for Google? You know, as you can see in the bottom, total equity for Google from 2016 to 2020 last year was from like 140 billion to 220 billion. That's not even double the size, right? So what about the total liability? You can see here, okay? If you can see my cursor, the total liability from 2016 to 2020 was actually from less than 30 billion to be way over 90, almost like 100 billion right here, right? So that's a 3 times growth. That's a three times growth. The triple. The liability just got tripled in 4 years. But the total equity is not even double. What does it mean? It means like, you know, the amount of liability, the amount of debt and bonds, just like borrowing for Google, has been increasing much faster than the value of equity, right? So that is saying like the increase of the value in the stock price is just an illusion, right? Because it's actually from the, you know, the liability, the increase in the liability. You know, think about that. So this is just like, you know, I mean, okay, let's have an example here. If you're making like $100,000 a year, and then you borrow $100,000 a year to buy a house, right? So you probably can still afford to pay back like is with your like monthly income, like, you know, just like year by year, right? But if you are like making $100,000 a year and you try to borrow $500,000 a year, do you think you will have the chance to pay back? I mean, the only chance is like you know, you become like a, you know, your productivity, your productivity become like super, have a like, you know, have a really big jump last year, right? You can make like a $300,000 to $500,000 next year to pay back the debt. If you like keep making like $100,000 like every year in the next like 3 to 5 years, how are you going to pay back the debt for like $500,000 you just borrow, right? So when you have like when you borrow like too much debt, you issue too much debt, you're gonna like be in a like financial trouble, right? It's a thing for corporates, for any government. So we just you know, the time is limited, so we just had a Google for example here, and later on I just next time I will try to like, because I have like some really, I think it's really meaningful and helpful information, but maybe it's not, as always, it's not like they're not like organized enough like to be concise and you know, and brief. But I probably next Tuesday I will make all this, I will organize all this information to be more concise and brief and easy, and you know, it's audience friendly for you to understand. Again, so my points today is that U.S. government have been printing money, like all the American corporate, American government has been borrowing money to make the illusion of the economic recovery and the growth, and also, so we have to think really deeply. Is it really a good sign, or is it going to be a potential nightmare in the U.S. stock market for trader investor, right? As a trader investor. Okay, so like I copy and paste some of the links in the description box, and you can see this is like S&P 500 PE ratio. We can, if you look into some, this is like Nasdaq debt to equity ratio. We can see. You can see like from 2009, which is just after 2008, the financial crisis. The debt to equity ratio have been, for Nasdaq company, the debt to equity ratio has been around like a 0.5 to 0.4, you know, even, but in recent year, you know, since last year, the debt to equity ratio has surged to be over like 0.9, which is like double the size of what we got, like, you know, just 10 years ago in 2009. What we got in the past like 10 years, right? So it means like the Nasdaq company has been like, you know, just like raising debt very, very hardly, you know, started from 2020 last year. So is it going to be a trouble? And I mean, also like mentioned in the article again, like by the Bond King, saying that in the pandemic, the job market recovery, the GDP recovery and all that, is it that just an illusion, just a fake, like, you know, like a fake beauty? You know, we just borrow money and spend it. We borrow money and spend it to making an illusion like, you know, we're still having a lot of money. But actually, we're having like a, you know, super historically, I mean, record high debt to equity ratio in corporates, in governments, in individual, like everyone. So I don't know if it's gonna be necessarily a bad thing. I mean, once the bubble collapse, like once the crash happen, who are going to be the worst loser? Are they going to be American, or they're going to be like those, like, I wouldn't know, global investor from other country, from China, from India, from Europe, from Africa? We don't know, right? So that's a bigger picture. But I mean, for as an individual trader investor, what we can do is I just want to share the facts. Okay? So we just have to be prepared to do some asset allocation. So you can also see the chart here. This is United States gross federal debt to GDP, you know. So the debt to GDP ratio right now, as we just mentioned in the debt clock website, we can see it's over 100% right now. It's you know, it's already like gone as high as what we got like around at the time of like a Second World War. What's the problem? We need to have that much debt. It's Second World War, 1940. We have a debt ratio around 120, but right now we have a debt to GDP ratio like about 125. What's the problem is that? Think about that. We have so much debt. We're really in a, you know, we're really in a bad debt. And you can also like see this. These US companies have the highest debt to equity ratio right now. You can check into that, okay? So my point today is like, you know, it's not a question. US dollar is declining. US dollar is falling. And it's a, you know, it's just a zombie. It's a that jump right now, and it will just like keep like going down below 100, below 90, below 80, below 70. And what will happen after the decline of US dollar? You know, the US stock market gonna crash. You know, we're gonna lose our buying power. We can buy less things, and when we can, that's a lot of like bigger and bigger issue. Like when we can buy less things, we will have inflation, like worse inflation, stack inflation, and all the problem. You know, I mean, at a time, like probably maybe in 1 year, in 3 years later, we cannot. I mean, it's not only the problem that we cannot make more. I mean, we have to make less money, but and then the money we make is available to buy less things, and while the prices, all the prices are still increasing. So what's gonna happen? What's gonna happen? It's going to be a super huge problem by then. So think about it. Okay. So I know that the information I'm trying to put in today is kind of like not that much organized, but I will do that again next time. And so let's see. Okay. So thanks, Michael Barry. Too poor to leave. We have to live with COVID for a long time. Yeah, COVID is not a problem. We have a lot of like financial economic problem besides COVID. And exactly the tapering is about to begin. And soda cookies, yes, like we have been living with cockroach and the mosquito for centuries. And cool website. About to, but still not sure about exactly date. Okay. So very soon, Michael Barry. Very soon, banks are running out of funds too. So so you guys are bearish. I actually like Michael Barry. Like I'm not like. I think like bearish is I would say, I mean. I'm just hoping to be more like conservative, like during such a market condition, okay? But not necessarily bearish, because I mean, in the past like 1 year, maybe I have been like too bearish, so I lost a lot of like chance to make money. But a lot of times it really depends if you want to be safer or you want to be greedier, right? If you want to. Right now, I mean, like since 2020, I thought like, yeah, like making profit is important, but a lot of times I think it's more important to be to be stable with your investment and trading, in the long run, right? In the long run. And so yeah, so Snowy Sophia is neutral, and how do you feel, Baron? Oh, okay. Barrel, okay. Yeah, Barrow. Yeah. So yeah, thanks. Yeah. So sorry, my channel is just like creative for just for not too long, and maybe I have like too much like things like to be busy for recently. So my brain is kind of like congested. It's kind of like jammed, so I can't even speak very clearly and to be articulate today, so I'm like sorry about that. But I really think the information I've been trying to organize and trying to share today is really going to be meaningful, helpful, and interesting. But although I cannot make them concise and precise enough today, but I will try to organize them a little bit more and come up with them back up again next Tuesday in the live stream, along with some of the market event going on, and some of the hot stocks we may have the chance to take some profit. And next Tuesday is going to be after the Labor Day on next Monday, so we will also be able to see like if there is actually a Labor Day market rally or not. Okay, so I mean today, I mean like I just want to say like a lot of time I mean, instead of like drilling into too much details of like single stock, sometimes we need to step back to be more calm and relaxed, to look at the bigger picture, to see, you know, what we can do, right? It's just like, can you imagine? Can you imagine? You are. I mean, there is a like gambling table, right? There's like 10, 20, like, you know, tens of, you know, like dozens of people, like, you know, just like, you know, crowded around a gambling table. And I mean, you just want to be like one of them to see, oh, what I can do, how, like, what's the bet I can do, like, what's the money I can take, and, you know, get crowded in those crowd altogether. But sometimes after a couple hours, no matter you win or lose, you still need to step back to see like how the table has been going, and what's wrong with your P&L, and I mean, rearrange with your strategy before stepping again. Okay, that's the point. And when we step back from the stock market, from the single stocks, from all those figures, all those like you know, just massive information, you know, when we come down, we can see the entire system, the market is running a little bit abnormal. But I'm not trying to be biased. I'm just saying, if it's abnormal, what would actually happen for the next, and what would be the action we can take, you know, to be more prepared beforehand, to, you know, if anything really happened. Okay, so okay, sorry, I'm a little bit like, you know, just messing my brain today. So, but anyway, thanks for your time. And thanks for watching. It's Friday, and I hope you will enjoy this weekend, and we will have more in the next one, in my short video or the live stream. I'll see you.